JP Morgan has just killed private credit and it's worse than 2008. This is a $3 trillion market, but when it collapses, it's going to take AI with it, and AI is an $8 trillion market, so that's $11 trillion right there. Look, I'm not going to waste your time with the reasons. I'm just going to tell you how they're killing it, and you can decide if you want to spend another 5 minutes here in my thoughts on it. So first, JP Morgan and Goldman Sachs are quietly building bespoke tools for hedge funds to short the private credit market, to short it. And this is the exact same scenario in 2008 when tools were built for hedge funds to short the housing market. Second, we're going to look at the massive liquidity trap closing around retail investors who are chasing yields in the private credit market. And third, we're going to look at why this is starting to give off some serious 2008 financial crisis vibes. Anyway, my name is Nick. I've been a professional investor and non-professional trader for 24 years. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube. I'll slow down now that the disclaimer is over. Right, so let's figure this out together. Right now, institutions and the media are pushing a narrative that private credit is the future of finance. Because after the 2008 collapse, there were limitations put on banks lending money to risky borrowers, to basically companies or businesses that have no business borrowing money because they don't have, you get the idea. But those risky borrowers didn't just disappear. There's always crappy businesses who are looking to borrow money. So the lending moved into the shadows, into shadow banking. That's what it's called. But the banks learned a very important lesson in 2008. They learned that it's a bad idea to lend your money, as in the bank's money, to crappy borrowers, to risky borrowers. Instead, they started lending retail money. Institutions like BlackRock and Blackstone took retail money promising high yields, high returns, and lent it to risky businesses, giving out risky loans, allegedly. They convinced retail to pile money in by bragging about how private credit was a growing, safe market, it's the future of finance, and that the underlying corporate borrowers, the people they were lending money to, were perfectly safe and fine. So basically, the messaging was, just relax, collect your 10% yield, and we'll keep lending to these perfectly legit and upstanding businesses. But here's the catch, because there's always a catch, and the media always forgets to mention this. Over the last month, a lot of these private credit funds have run into a little bit of trouble. Investors are getting cold feet and they want to pull out. But the funds run by BlackRock, Blackstone, Morgan Stanley, Blue Owl, and more have started to limit withdrawals, ostensibly trapping in retail money. Which is why JP Morgan and Goldman Sachs are actively assembling bespoke baskets of publicly traded companies for hedge funds to short. These baskets are filled specifically with alternative asset managers and BDCs that have massive exposure to the private credit sector. So I'll translate this for you because that sounds very confusing. This is basically a death warrant for private credit. Over the last 4 weeks, we've been seeing signs that private credit is dying, but a lot of people have been denying it. I made a video about this like 3 or 4 weeks ago and people were saying, oh, you're crazy, you're blowing this out of proportion. But now some of the world's biggest banks are starting to short private credit just like 2008. And what do you think comes next? Because private credit loans are illiquid and they don't trade on public exchanges. Hedge funds can't short them directly, so the big banks have built a proxy mechanism to short the gatekeepers instead, to short the people who are handing out these private loans, right? And they are betting that the valuations of these private credit managers are about to completely collapse. So why is this happening? Now, why are they shorting? Because the underlying plumbing of this market is severely stressed. Fitch Ratings just reported that the default rate for privately monitored middle market companies nearly doubled to 9.2% last year. And a huge part of this is driven by the software sector. Private credit has roughly 21% of its direct exposure tied up in software companies. These are asset-light businesses that are currently being completely disrupted by artificial intelligence. And do you know the worst part? Larry Fink, CEO of BlackRock, is desperately trying to get private credit into 401ks. What are 401ks for those of you who aren't American? That is hardworking American people's pensions. That's what a 401k is. He's built a toxic heap of loans that are about to explode, allegedly. The cracks are starting to show, and he needs dumb money to replace his money and keep the show running a little bit longer so he can extract as much as possible, allegedly. And I don't want to get political, but Trump is helping him out. On August 7th, I think it was August 7th last year, Trump signed an executive order called Democratizing Access to Alternative Assets for 401k investors. So this is quickly becoming a race against time for retail. Larry Fink needs 401k money to prop up this crumbling industry, while JP Morgan and friends are starting to short. And as always, retail is just caught in the middle. Most of them can't do anything, but what can you do? Just talk to your pension advisor or your financial advisor and ask if you have any exposure to private credit. That's what you should do. I'm not telling you to get out. I'm not a financial advisor. I'm just saying, do some research, ask your advisor, and then make a decision for yourself. But for me, it's not looking good, and I don't have any exposure to private credit, and I'm very happy that I don't. I'll see you in the next one.